We've talked a lot, again, like I said, about the importance of markets and finance. When Suzanne and I were planning out this conference, we decided that it was very important for people to have a sense of what is capital, and particularly for the audience that we're talking to, all of you, that is not an area that we usually spend a lot of time on. So this particular part, the last session of this afternoon, yes, we're between this session and dinner. We wanted to focus on the whole issue of capital because capital is like the fuel. But where does capital come from? Who provides the capital? What are they looking for when they provide the capital? And what are the risks associated with it? And at what time is it appropriate to use which type of capital? So while it's a big generic term, we thought it is important to give some framework, some definition for what is capital and what type of capital is most appropriate. So to start it off with an overview, to lay out the different types of capital, private capital, public capital, debt, fixed income, blended finance, all of those terms, is Tim Runnels. Tim Runnels is the director of what they call real asset investments, but his career covers different types of assets. You probably say, what is real assets? And you will hear from him. And so Tim is the director of real asset investments for Ascension Investment Management. He will provide the overview, and after that, we will have a panel to get into the different layers of finance, and particularly finance that relates to the smallholder farmers, and finance and capital that applies to the businesses that support the farmers or aggregated from the farmers. Now, let us bring Tim Runnels. Please give him a warm welcome.
Thank you for the warm introduction, Carolyn. I really do appreciate it, and thank you so much for your attention this afternoon. I'm going to be talking about, I think, one of everyone's favorite topics, and that's money. So, where does the money come from, as Carolyn alluded to? I thought the audience would be a little bit larger for this part of the presentation, but I won't take it personally. No, exactly. When we start handing out the checks, they'll show up. So, but anyway, really my goal is really to set the stage for the panel. We're going to have a great group of panelists, and again, as Carolyn mentioned, it's going to be more definitional, but really hopefully gives you a framework to think about when the panelists are speaking, how they fit in the capital markets, and that's really what my goal is today. But before I do that, I do want to introduce my firm, Ascension Health and Ascension Investment Management. You're probably not that familiar with them, so I'll speak quickly, but Ascension Healthcare is a large not-for-profit Catholic hospital system founded by the Daughters of Charity and Sisters of St. Joseph. We have over 150 hospitals throughout the United States. The ultimate mission is healthcare for those who can't afford it. So one of the metrics we use at Ascension is our $1.8 billion that we gave away in free healthcare last year to the less fortunate. So that is the ultimate mission of Ascension and really what we're trying to do as an institutional investor. I work for Ascension Investment Management, which is a wholly owned subsidiary of the hospital system, is to generate enough revenue to help support those operations. So we have roughly $39 billion in assets between our balance sheet and also our pension plan. We also help manage third-party capital for investors. And really the goal is to support that mission. One of the hallmarks of Ascension and our investment program are our social responsible investing guidelines. So we do try to be good corporate citizens and to align ourselves with our mission and our values. If you think about us being affiliated with healthcare, tobacco, alcohol are typically not going to be things that we are encouraging in our investment portfolio. And not only Ascension benefiting from that, also our client base is benefiting from that too as well. I've got all our team members up here. I'm very blessed to be able to work with a very large investment staff. We cover all the different major asset classes at Ascension. I won't name all their names. I will mention our Chief Investment Officer, David Erickson, who joined Ascension in 2009. He came to us from the University of Wisconsin, so technically he is a Badger, so I apologize about that with this being Boilermaker country. He was the CIO there, and then myself, I'm circled at the bottom. That's not by accident. I am at the bottom of the totem pole for Ascension, so I apologize again because you're talking to me today. But I cover real assets. If you think about real assets, those are energy, infrastructure, timber, commodities, real estate, agriculture type of investments, inflation-related type of investments, so things that tend to do well in an inflation environment. And I do that with my associate, Tyler Blickhand. I've got all the different investment strategies and asset classes that we covered at Ascension grouped by growth environment, inflation environment, and a deflation environment. These are the asset classes that we think are going to do well in these different types of scenarios. And I also have, going from the left to the right, more traditional investments like stocks and bonds, very liquid, that you're going to be familiar with. Moving to alternative investments, you can think about hedge funds. And then finally, what we're really going to be focusing in on today is private capital investments. And that's why I have those two areas circled. That's where I spend the vast majority of my time. That is the longest dated capital that we have. So you can think about investments being made for 10 to 15 years. And we think it's really important to give impact investing and also agriculture investments that type of duration and that type of time to ferment it. Agriculture investments, impact investments are really not a trade. They're not something you can get into in 6 months and get out of 6 months. So we really think that having agriculture and then also impact investing lined up appropriately with private capital investing is important. Now I just want to shift gears and hopefully tee up the agriculture capital markets a little bit, and then also to highlight our distinguished panel. You can see, I think the ultimate point I want to make on this slide is that the investment universe is really quite large. So we have $69 trillion investable assets that investors can invest, across the world in close all different asset classes. And really that's what agriculture is in competition with. So unfortunately, $75 billion is dedicated to agriculture-specific type funds, and it's almost a drop in the bucket. So we talked about policy as being a barrier to investing in agriculture and emerging markets, but it's also size and scale. Most institutional investors right now are more focused on technology. If you think about Facebook, Netflix, Apple, Google, those kinds of companies. Unfortunately, agriculture is really not a focus for most investment departments. So even if you have a great idea, you're going to be challenged to really get a lot of attention at the institutional community. So that's important to know when you go in the door. That being said, we are seeing some more growth in the actual asset class. So it's coming off a very small base, but I do show a table at the right that shows agriculture-specific funds growing over time. Some of that is just a general shift away from the public markets to private capital funds, but diversification, inflation, and a willingness to take on more emerging market exposure is a reason we're seeing more interest in these private type of vehicles. And this probably comes no surprise to everyone, but agriculture is a global asset class. People invest in agriculture around the world. I've got the different percentages up there, though. I think the biggest surprise to me, though, is that North America or the United States captures so much of the investment dollars. So I think universities like Purdue, research and development institutions around the United States is capturing a lion's share of the venture capital. So that's great, testament to why North America is a leader in technology. But also, if you think about how easy it is to do business in the United States, growing conditions, it's going to be a much higher value per acre in the United States than typically around the world, which is driving why a lot of investment is needed in the United States. That said, if you go to a region like Africa, for example, 15 to 20% of the world population, just even kind of looking at this chart, you could say, hey, those particular areas of the world are underinvested in and really to be given more attention. So maybe an opportunity exists there. On this slide, I try to highlight the shift away from the public markets. So historically, investors had thought, well, if I want to get access to agriculture, I'll go invest in public stocks. And you can really see that was the case in 2010. However, as you kind of march forward through time with the emerging market challenges, with the strong dollar, with lower agriculture prices, the public securities have not reacted well to those macro forces, and you've seen a shrinking of public security investment by institutional investors and other types of investors. What's really taking up the slack are the two bottom blue wedges, both being farmland investing and also private capital. So you can see, again, private capital taking share from the public investing universe. If you squint a little bit, you can see venture capital and also private debt or private capital starting to take a little bit larger share in years 14, 15, and 16. This is the part of the presentation where I'm going to try to start integrating the panel a little bit and talking about some of the different private pools of capital out there. So the first group of investors I want to highlight are not-for-profit investors. We've got very fortunate to have 1Acre and also Root Capital here going to be on the panel today. The work that they do in regards to laying the groundwork for private capital investment really can't be underplayed. These groups are willing to commit equity dollars with a long tenor to come in and really lay the foundations of what's needed in these areas to make private capital sustainable and growth. They're able to come in with education, training, logistics, working with governments to ensure that it's not an exploitative relationship when the private capital comes in. It's really a partnership. So I'm really looking forward to hearing about the nonprofit efforts on the panel. The next group of investors I want to highlight are development financial institutions. We've heard from obviously the African Development Bank and the World Bank and you know the great effort and work that they do. They're primarily focused on the debt capital markets. Obviously, with the name like bank in there, you'd expect them to be focused on debt, and that's exactly what they do. The example given yesterday about in Nigeria, where the African Development Bank was able to go in and backstop a lot of the loans being made in the agriculture space, and then opening up, you know, creating multiples of capital and liquidity in those markets, I think is exactly what I think of when I think of development banks. Typical regional players that are really looking to incentivize growth in those countries. Very important to finance. The next group are sovereign wealth funds, so a growing group of investors in emerging markets, groups that are looking to strategically control supply, so less focused on profitability, but much more focused on ensuring that supply, that commodity is going back to that home country. So examples would be China Investment Corp looking to ensure that they have the corn and the iron ore to feed their strategic vision going into the future. Another group, and this is where I spend all my time, we're going to transition into more private capital and investors looking for market-based types of rates of return. The first segment of this is really farmland investing, and you can just think about this type of investing is investing in dirt. So if you think about just owning the raw farmland and then the farmers coming and using this farmland, and they're providing the expertise on growing and the seeds and the tractors, the farmland investors are really just looking to get a rental income. So maybe they share in some profit, but typically they're going to be looking to get like a 6 to 7 to 8% type return, primarily in the form of cash yield. You can think of insurance companies or pension plans looking to match an asset and liability. You get a little bit of inflation protection. We see this a lot in the United States and in Western Europe, less so in emerging markets, but there is some growth in those regions of really kind of bifurcating the actual ownership of the farm and then also the farming activities. And then finally, you're left with private capital, and this is where we'll spend the bulk of the remaining the conversation, where the panelists are really going to be hitting on, is that private capital can be segmented into a few different types. You have venture capital, you have impact investing, you have private debt, and you also have private equity. This type of investing is really the longer duration type of investing that we talked about, and you can think about it as you know, building businesses over time, stabilizing those businesses, and then looking to sell them. And we have a great example of Sahel, which is going to be on the panel today, as an example of a private equity player in an emerging market. So again, looking forward to your participation in the panel. Now just to dig into venture capital a little bit. I know this term is kicked around a lot by a lot of different people, a lot of different industries, but just the simplest way, did I go blue screen? No, okay. I think one of the simplest things to think about with venture capital is to think about kind of research and development, and that being sponsored by private capital versus public dollars. So the focus is really bringing new technologies to market as quickly as you can in a profitable manner. Typically, these companies, the venture capital funds, are going to be taking minority positions, and what I mean by that is not owning more than 50%. They're not going to have control. They're going to be typically in that 15 to 20% type ownership range. They're looking to spread their bets around as much as possible because there is so much risk. Also, they're going to be demanding extremely high rates of return. So 35, 40% type internal rates of return, multiples on their money. That's really what they need to justify to go in and make some of these venture capital investments, because there's going to be a lot of zeros. There's going to be a lot of losses. There's going to be technologies that don't work, that don't get to market. And to cover those losses, your winners really have to win. So when you think about venture capital, in the back of your mind, how scalable is it? How much money you're going to be able to make? It's very important to the venture capital industry. And again, I've got a laundry list that I'll let you read of different technologies and venture opportunities in the agriculture space. I do have a real life example that we made an investment in. It's called Cultivian Sandbox. This is a group that spun out of Monsanto. It's a research and development group that spun out of Monsanto. In 2013, this group made an investment in a company called Assimilar Bio. Assimilar Bio is essentially a chemical company which when you apply their chemical to plants, the plants become much more efficient in moderating their water usage. So kind of a classic venture capital type of investment where you apply this chemical to the plant and yields go up by 20 to 30%. The surprising part of this technology is not only does it work in drought-like conditions, but it also works in extremely wet-like conditions. So, this is kind of your classic your classic venture capital type investment. Ownership is low. They only have a 19% type ownership in this company, but they are looking to generate a 35% net internal rate of return. And just like you hear the term internal rate of return kicked around, but this investment was made back in 2013. So each year from the time of that investment, they're looking to generate a 35% return. So you add all those up together, and you're looking at multiples on top of your money. So again, very high returning. The next segment of capital that I like to talk about is private debt. And again, I think the African Development Bank did a great representation of traditional lending, really not meeting the needs of investment in emerging markets or in the agriculture section. Traditional banks, because of regulation like Basel III, are no longer looking to take the volatility associated with commodity prices or the volatility associated with emerging markets. Also, they're not looking to extend loans past 5-6 years anymore. So private capital is able to step in and provide that particular wedge and need of capital in the capital stack. Two ways that these investors invest are through trade finance and also project finance. Trade finance essentially is helping farmers manage the cycle. So you put your seeds in the ground in the spring, and then you harvest in the fall in the United States. And during the summer, you still need cash to run your operations. Banks, these private capital banks can help you do that. And also with project financing, if you need to build a warehouse over a 5-year period, logistics, you could go to a private capital provider and they can help you do that. Again, different types of companies, and I could name multiple ones, but I'll pick one that we have a relationship with called Emera. They're focused on Latin America, and they're focused on the agriculture sector. They have made an investment with a group that they had known since the 1990s. Essentially, it's a Mexican logistics import-exporter out of Mexico. It was a spin-out of a publicly traded food distributing company. Essentially, with the fall in sugar prices in 2013, 14, and 15, this company came under large distress. Traditional banks do what traditional banks do in these types of situations. They want to seize and they want to foreclose and they want to get their money out. This company didn't want that to happen, so they went to Emera. Emera was able to recapitalize the company, get it on steady footing, but Emera wanted to be paid for that. So the compensation that Emera received is a very high interest rate at 6%, plus a floating component to it, and they did receive some additional fees. And the biggest differentiator is that Emera took equity in this company as well. So unlike a traditional bank, which is not looking to take ownership, private capital, it's very common for them to want to participate in the upside if things do work out well because they are taking on the additional risk. Emera stepped in and took 15% of the company. The next group of capital I'll talk about is private equity. If you kind of think about venture capital as the new super technology, private equity is much more about basic blocking and tackling, bringing in institutional know-how and management skills to enhance an asset. So typically an entrepreneur can bring an asset only so far. They start out, they develop the asset, they bring it to a certain point, but then new CEOs, CFO, chief investment technology officers are brought in to bring that asset and help that asset grow even farther. So that is kind of your classic private equity type investment. Investors are looking for a high rate of return, not as high as venture capital. So they are looking for kind of a 20, 25% net internal rate of return with these investments because you are locking your money up for 10 plus years. Again, you can invest across the value chain within agriculture, the upstream, midstream, and downstream. Upstream being closest to the seeds, downstream being closest to the ultimate consumer. And again, I do have an example of an investment that we made in the private equity space. This investment was with a group called Proterra. Proterra is a spin-out of Cargill, so the large U.S. food manufacturer. Proterra made an investment in a group called Riverstone Farms. Riverstone Farms is essentially hog farming in China. So Not a lot of whiz-bang new technology being used, but just taking best Western practices, having control, and be able to use and be able to build that essentially in China, and they were able to create a lot of value by doing that. So one of the things that they did was to essentially segment the pigs by age and size, and you can maximize nutrition and get them through make sure they're getting the appropriate exercise and workout. And by doing that, they were able to increase production by 50%. So your typical Chinese farm, this farm can produce 50% more pigs than relative to your typical Chinese farm. So if you think about swine flu and food security and food safety, this company is also addressing that. Often in emerging markets, the country is not there to enforce quality standards. So branding becomes very important. When you see a Riverstone Farm hog, you know it's been treated properly, and if you eat that, you're not going to be getting sick. So they're able actually to charge a little bit of a premium in the marketplace because of the high quality of care and the traceability of the food, if you will. They are looking to generate a good return off of this investment, 25%, and they do control this investment at owning 90% of the equity. We're going to switch now to, and this will be the last part I'll talk about, is impact investing. So we are very fortunate to have Pat Deneen in the audience today from Impia. Really looking forward to her presentation and how much more she can elaborate and do a better job than I'm going to be able to do to talk about impact investing. But if you think about impact investing, most people can agree that it has kind of a social component and also an environmental component to it. And then again, most can agree that people are looking to generate a market-based return. So groups that are interested in impact investing reach out to groups like Pat Deneen with Impia. They look at the United Nations Sustainable Development Goals and look to really measure and to think about how they can maximize the impact and to get what they get when they make their investment, right? So what do you think you're going to get at the start of the investment, and what do you actually get at the end of your investment? How do you measure that? How do you trace that? Very important when you think about impact investing. I do have to say that I'll give more credit to Ascension. I think we are one of the leaders in impact investing since 2014. We have raised 2 dedicated impact investing funds, and so not only Ascension Capital, but also including third-party capital. We have a stewardship mandate at Ascension. It's part of our mission. So we see it as kind of a small piece now, but a piece of our portfolio is going to be growing much more over time. And I think we're not alone as institutional investors looking to broaden out the benefits of impact investing. I've got on the slide, and you can read how we defined social improvement and environmental stewardship. I won't read all those to you. I'll let you read those at your own leisure. But again, looking to have a positive impact in the community and also generating a good financial return. One of the investments that we've made is with a group called Silver Street. Silver Street was founded by a group of former Zimbabwean farmers, so a group that is very familiar with the region of Africa and knows what to look for and try to avoid some of the potholes of doing the investing in Africa. One of their investments was in a company called a Tanzanian poultry farm, essentially focused on the sale of day-old chicks. So this company essentially started from scratch. One of the innovations they brought was to introduce a specific type of chicken called the broiler chicken from France to replace the typical village chicken that was being used by most of the local farmers. That is very different than the Cobb chicken that we use here in the United States. The Cobb chicken is more of a white, and politically it didn't really exactly work because it needed much more care and nutrition. The broiler chicken was the optimal chicken for doing business in Tanzania. They've noticed significant gains in production relative to the village chicken, more eggs, more protein. It's really been a great success story. They've reached over 22,000 farmers and are now distributing through over 5 countries throughout Africa. The success has been measured not only in the farmers, which have noticed a doubling of their income by selling this particular type of chicken, but also kind of the ancillary benefit is that now there is a market for soya. So soya is a product which is much more in demand relative to maize. By switching from maize to soya, those farmers were able to generate almost double annualize their income. So it doesn't sound like a lot of money, but when you're able to double your income, you're able to maybe have a child not necessarily work the field, maybe they do a little bit more studying, maybe you can afford more electricity, and then you're able to raise yourself out of poverty that way. So having a very large impact and kind of quite scalable for such a small investment. The World Poultry Foundation is looking to expand their efforts and has provided grant money to Silver Street to also further this benefit. You know, this all being said, they are looking to generate a market-based return. So an IRR of between 13 and 18% is the type of return they are targeting, and they do have control to make sure that they can control the hatching and the growing process. That is very important to private equity and to impact investing. So hopefully, I know I talked extremely fast, but I did want to cover a lot of ground in a short period of time. And I do want to thank all of you for your attention today, and I'm really looking forward to the panel. And I want to appreciate Carolyn for all the efforts that she does here, and thank you.
Tim, thank you very much. And Tim's slides, and they're more than the ones that he showed, will be on the website. You might want to go through that deck. It's fairly comprehensive just so that you could follow all the terminologies. So now I'm going to bring the panelists up and ask them to take a seat. As they're doing this, I just want to connect a few dots. Yesterday, Akin said, aid will not solve the problem. We cannot rely on aid. We have to rely on business, and we have to rely on investment. That is exactly saying that we need to have another form of capital. If we cannot just rely on capital from government as aid or from philanthropy as aid. We need to bring in what is private capital, your and my money through our investments and our pensions. So that's the connection, first of all. If it's not aid, if it's business, we're really talking about capital and where it comes from. The second thing that I want to emphasize before I take my seat is that the first bullet in Tim's presentation said capital is coming from not-for-profit. So you have to think about the foundations. Just think about the foundations that you have received grants from. Many of you wrote for grant. Grant is for a project. You receive your grant and you did your work. For some of the foundations, most of the foundations, they're now experimenting with not giving you a grant. A grant is, you give you the money, is done, you did your work, you proved the technology, but giving you investments. So instead of a grant, it's the whole idea whether they could use that money and provide an investment to some of these startups, because an investment is not just that they want to have a return back. That is their lowest priority, which is to get a return on their money. It's a different form of discipline. And that is to give investment. You're really talking about supporting a business. That business requires a business plan. That business plan has to address revenues and costs and sustainability. Revenues mean scale. Can you generate the scale? So even in the not-for-profit that we are used to dealing with, they're beginning to think about this. And again, implicit to this transition of just giving grant to giving an investment is really this whole conversation about, can we see beyond a technology into a business? And finally, that's what Simon Winter said when he closed the panel earlier on. And he said, we're not funding a project. This is not a grant for a project. When he talked about CUSA, he said, this is a business. So let me just go sit down and now turn my attention to the panelists. I'm going to proceed in a particular order because there's a story, you know. I'm going to start with Pat Deneen, and Pat spent her life in investment, particularly in emerging markets, and now she's very focused on the area of impact investing. She is head of the Impact Investing Initiative of Empire. And Empire is Emerging Market Private Equity Association. She also started and now convened the Catholic Impact Investing Cooperative.
Collaborative.
Yeah, and And what impact investing is basically using private money. That private money can be from you, from a foundation, from a business. That private money can be in a form of equity, which means you take ownership, or in a form of a loan, sometimes as a guarantee. But the purpose of impact investing, and Tim explained it too, is to really start businesses that address social problems, that have social impact, while at the same time generating a return. There's a debate as to what level the return is. It's clearly not 35 to 45%. That's not the expectation, not even 25%. Tim mentioned when they make impact investing, they are expecting 18%. So Pat is going to start us off because of a focus on impact investing.
Great. And first of all, thank you, Carolyn and Suzanne, for including finance and markets in an agricultural scale-up conference. It's vitally important. And Larry Kohler, this morning, you said there are no fully commercial solutions in agriculture. Well, I think that we can show you plenty of examples within sectors of agriculture where you can certainly make a profit. And Leonard, this morning, we talked about it at dinner last night. How do you attract people to agriculture? Making it profitable. That's one way to do it. Impact investing is not new, certainly to anybody in this audience. It's been around for a long time, but it just wasn't called that. But when you have an intention to actually accomplish social benefits and outcomes and environmental outcomes alongside a financial return, that's impact investing. Simple as that. And one of the things that's really startling is that there is a wide definition, and Tim really focused on private equity and venture capital, but impact investing is just a lens. It can apply to any asset class, whether it's stocks and bonds, whether you're investing in big corporations or startups. It's what you intend for that investment to accomplish. He put up on that chart this incredible number, $69 trillion in investable assets, but only about 75 billion in food and agriculture funds. Well, it's even smaller than that when you get down to agricultural impact investing. So my objective on this panel, and I'll try to do it very briefly, is to say there is a huge potential that we can unlock in impact investing, because arguably, agriculture is one of the most inherently impactful sectors. So how do we start unleashing that pool of capital? Why is there so little of this capital going into agriculture? In the first place, there are very few specialized agricultural funds, so it's usually part of a diversified strategy. And in terms of the orientation from an investor, 3 questions, 3 different dimensions: impact, risk, and return. How much risk are you willing to take? Tim mentioned that venture capitalists are the ones who take the highest risk, but they expect the highest return. If you're willing to take perhaps a little bit more risk, but you're not going to expect as much of a return, then maybe you would be more inclined to look at agriculture. If what is really important to you is to have a huge impact, then you may not care whether or not you have a huge return, or even more than getting your money back, or even less. And that would be largely the grants. Now, I've got one slide to show you. That's it. Very simple, but it's also very profound. When you look across this perspective, and I put them into different boxes, but there's overlap, and I'll tell you in a minute. That's called blended finance. So if we start on the left-hand side, and we've got 2 speakers that can address the A boxes. Those are the commercial returns. Sahel Capital, Mizu will be talking about that in a minute. Tim Reynolds just spoke about Ascension Healthcare. Market-proven models, institutional capital, where there has already been a lot of institutional capital, but you can still add value by bringing in people on the ground with operational expertise. Second A box is very exciting. It's where you expect to get good commercial returns, but you're willing to take the risk that other institutional investors haven't taken yet. Maybe because you know the local markets and you know a lot about agriculture and about the geographies. And that, again, Ascension and Sahel. Now moving to the middle category, the B category. And we've got two panelists that exemplify that category. Sub-commercial returns. So you're not looking for the huge commercial returns from the A box, but you're not willing to lose all your money either. So this is the category where you would want to at least get your money back in the case of the B2, and in the case of B1, maybe get a decent return. Not an outstanding return, but maybe a decent return. And you're willing to settle for a little bit less return if the impact justifies it. And then finally, in the category to the far right, you've got three categories of grants. Those where you're not expecting any cost recovery, and then where you can get maybe medium or finally maximum return. Now, what's really interesting about this chart, it's not static, it's dynamic. So the real challenge, and I think for many of you in the audience, if you want to raise money and if you want to scale up your enterprises, how are you going to get the money that's from the grant side, which is now demanding more sustainability and more scalability as well as impact? How do you get that more into the B category and eventually into A category? And I'll tell you, if you look at the statistics, you know where most of the money is? In the A category. So what we really need to do, and we'll talk about it on the panel, is how you inspire these investors. This $69 trillion of investable money, how do you get some of that to be excited about investing in impact?
Thank you, Pat. That was great, and thank you for keeping to time. Now I move to Brian Hees from One Acre Fund. Brian is the Chief Investor Relations Person. A little bit about One Acre Fund. We're going to start at the micro level, and that is One Acre Fund lends to the farmer, the smallholder farmer who needs the working capital to buy seeds and to hold the inventory. And the farmer is a business person. So we have Brian talk a little bit about how you support the farmers and how you get your own capital to support them.
Yeah, thanks. It's a real honor to be here, and I appreciate everyone's interest in finance as well. Take a look at the picture of Sophia Ayuma on the screen right now. And I think it's important to put a face on impact investing, and Sophia is just one example of a great face that you can think of. Notice the tool that she's using to farm. Notice the calm, confident expression that she has on her face, because that's what comes from successful impact investing, is you're helping somebody feed themselves, feed their family, and improve their lives. And that's really what impact investing is all about, is helping people like Sophia. And I work for One Acre Fund, and One Acre Fund is a nonprofit social enterprise that is, that works in 7 countries in Eastern Africa. And we are focused really on smallholder farmers that all really do the same thing. And so as a result, that allows us to focus a highly sustainable model so that what we can do is do the same thing again and again and replicate it for hundreds of thousands of farmers, and we're able to improve all their lives. And our scale is quite significant, because right now we're serving 700,000 farmers in Eastern Africa, and our goal is to get that number up to over 1 million by 2020 and over 1.3 million by 2022. And we're doing that by working directly with farmers and also partnering directly with governments. And our model is very simple, really. And Dieudonné said it this morning. He said, you have to find products that people like. And what we do is we sell seed and fertilizer and solar equipment to the farmers. we sell it on a microfinance model, so they don't have to pay for it up front. And that's very important because they run out of capital at the point where they need to invest in the inputs for the coming season. So that microfinance component is very, very important. We distribute it to the farmers' doors, and we train them in how to use it. And that training encompasses really two components. The first one is first of all, how to use the products and how to practice good agronomy practices, but then also how to store the results. And that's very important because we find that by applying all these techniques together, what we can do is help a farmer improve their farm family income by somewhere between 50 and 70%, depending on which year you use, which is fairly significant for a family. And you know, I was speaking to Violet Mugalave this morning, and she's a professor from the University of Eldoret and here at the conference as well. And she said to me, you know, my mom uses One Acre Fund products because my mom's a farmer, and we like One Acre Fund because we have great products. And that's really what I think it's all about, is because, you know, impact investing is important, but you have to also have things that people want, and you're not a solution looking for a problem. You've taken the problem and trying to find a solution that perfectly solves for it. Our scale has been very similar, I think, to the way that Larry described it this morning. You know, he mentioned the S-curve, and I think about that, and I thought about it, and I reflected kind of on our own scale trajectory. And we've been growing significantly since 2006, but really in the past several years, it's increased we're growing at about a 50% rate per year. And that's a function of one thing, I think, which is capital. And we have a very unique financing model in that we use both revenues from farmers and grant income to finance our operations. And that's very important because that gives us two legs of a stool that allows us to be very stable in almost all markets. And so right now it's about 50-50 revenues from farmers, revenues from grants. And by 2022, it'll probably be significantly more revenues from farmers, but you'll see we'll always be reliant on some grant income. And that's not the only component of financing that we use, because when you have a microfinance model and you're buying, you know, as we are 40,000 metric tons of fertilizer a year, 4,500 metric tons of seed each year, you have very long lead times for the products that we're selling to farmers. And so, you know, if you think about Kenya right now, they've just finished their harvest season for the 2018 season, but we're already planning for 2019. So we're making deposits right now on the 2019 growing season inputs. Those inputs will be delivered to our warehouses in December and January, and we'll distribute them out to farmers like Sophia in March. And so that whole process takes a significant amount of working capital. And so we're raising debt to fund the working capital deficit that we experience as a result of that very long cash conversion cycle. And we've had to be very creative in ways that we obtain that debt and the way we structure that debt to make sure that we protect both the lenders who are lending us the money, the farmers who are buying the goods from us, and then finally the organization itself. So let me pause there.
Thank you, Brian. Now we turn to Brian Mulder from Root Capital. Brian is the Chief Innovation Officer, but also he is the director of an alliance he's led in agricultural finance. So Brian is, One Acre lends directly to the farmers, Root Capital lends to the aggregators, the retailers, the distributors, the market. We talk about members of the market system. So they lend to Root Capital to the intermediate businesses. Okay.
Thank you, Carolyn. And I think the slides will be coming up. So I've been with Root Capital about 12 years now. And when I first started coming to agricultural conferences, we were more the novelty, and now we're part of the plenary. So I think that's part of the progress, is that there is more dialogue between the technical side of agriculture and the finance side, and some comments earlier today about the importance of building finance into the pilots and into the plans for scale. And I also wanted to footnote a comment this morning about the trade-off potentially between scale and impact. That's something that I think we see to some extent in agricultural finance and is an important topic. But I wanted to mostly highlight these stats in blue. I think the first stats around the importance of agriculture and livelihoods in Africa and GDP are quite well known, as well as the lag in government spending for agriculture. But there's also a very significant lag in terms of commercial finance that's going to agriculture. So it's less than 5% relative to that 25% GDP figure. The agricultural finance market in Africa is estimated at $240 billion, but only 25% of that market is being served. $180 billion of finance that is needed. And there's a particular need, there's a lot of need at the farmer level, the work that One Acre Fund does. There's also a lot of need at the aggregator level, so small and medium enterprises that are sourcing from smallholders or distributing inputs to them, trading, linking them to markets, doing value addition. Those types of small, medium enterprises are about 30% of the finance gap, so well over $50 billion. And that gap is typically referred to as the missing middle. So financing that's larger than micro, but tends not to qualify for bank loans. And it's needed all along the value chain, and small and medium enterprises, SMEs, play an important role, whether it's agro dealers who are distributing inputs to farmers, or producer organizations that are connecting farmers to markets, all the way through to the value addition end of the spectrum. So I'm going to talk a little bit about Root Capital and then also the Industry Alliance that Carolyn mentioned. Root Capital is almost 20 years old. We were founded in 1999. And we were founded to address a problem, a gap in the market, this missing middle, and with specific impact in mind. So we didn't start with capital and try to find a way to generate a certain return. We started with a problem that we wanted to solve. And we structured ourselves as a nonprofit because we were addressing that market failure, and we recognized that we were going to need to learn, we were going to need to experiment along the way. We now make loans ranging from $100,000 to $2 million. We also provide financial management training, which is a critical complementary service. We're targeting businesses, so whether it's a farmer cooperative or private enterprise, so that they can put together a cash flow statement, understand their financing needs, approach us or another institution for a loan, and then manage it. Certainly there's a lot of need at the farmer level as well for financial literacy. Again, we target the enterprise level. In terms of Root Capital scale, we do about $100 million a year in lending to roughly 200 businesses, and those businesses aggregate about 600,000 farmers. And about a third of that is in sub-Saharan Africa, and 2/3 in Latin America. Historically, we've done about $1.4 billion in lending to businesses reaching a little over 1 million farmers. So when we think about impact, our theory of change is to identify those enterprises that are aggregating farmers, linking them to markets. We want to extend access to finance where it's not already present. And we look at the extent to which those businesses are repaying and growing, and about half of them over a 5-year period stay with us and grow at about a 25% clip. And then we, most importantly, want to understand what's happening at the farmer level. We see more reliable market access, increased incomes, more stable incomes as well. And in addition, many of the enterprises are providing agronomic training, credit, inputs, and we estimate that farmer incomes are increasing about 20%. So this is an example from Kenya. Unfortunately, I didn't have a good picture, but it's a business that was founded in 2009 by a woman entrepreneur, Beatrice Nakatha, who's a micro-entrepreneur in her village before she started a sorghum aggregator. Sorghum Pioneers provides inputs, credit, agronomic extension, and then market access. And it's now reaching about 8,000 farmers, selling sorghum to a local brewery, to the World Food Program, and also to food processors. And the business has doubled their revenues in the last few years with access to credit, and the farmers report income increases of about 60%. And this is a viable business. And the punchline here is that Root Capital doesn't make money on this loan. So this business has repaid and grown, but it's very difficult for Root Capital to cover its costs. And that's one of the things that I mean about trade-off potentially between scale and impact. I also wanted to mention the industry alliance that we've developed with some of our peers and competitors. So there are now 12 institutions that work together, that share learning and data as well. And these institutions, some of them are well-known in the agriculture sector, Rabobank, Oikocredit, AgDevco, and working globally. And I'm not going to have time to talk about the next slide. Maybe we'll do it in the Q&A. But we're starting to share data through an independent entity that's evaluating the economics of these loans. And what they found is that larger loans to more established businesses tend to be more profitable for lenders. And smaller loans to earlier stage businesses are not profitable. So that's a lot of data to throw up on the last slide and not really explain. But basically the blue X's are profitable loans and the red X's are unprofitable loans. And if you look to the right, those are larger loans, so they tend to be more profitable. The ones on the left are smaller loans. They tend to be less profitable. And what's interesting too is that the majority of the unprofitable loans actually repaid. It's not that these businesses aren't viable, it's that it's very costly to serve them. So I just wanted to introduce that into the conversation because I think too often we talk about, well, is this an NGO? Is this a donor mentality? And you can take a disciplined financial institution approach. You can make loans. You may or may not be able to cover your costs based on certain market conditions. And I think the theme that Dr. Adesina introduced yesterday around policy incentives is also needed in the agricultural finance sector because we need more finance flowing into this segment that's very red. And it might not be fully profitable, but it creates the pipeline for investors like Sahel to be able to come in and grow those businesses over time.
Thank you, Brian. And now we have Mazu Nwaneli, who grew up in the investment industry and then went back to Africa to start Sahel Capital, which is one of those venture capital firms that Tim talked about that invest in companies which have a chance to go really big and take a high risk on them. He wears many hats. He also runs some of these startups, mentors these startups. So he also has run operating companies while he also manages Sahel Capital.
Thank you, Caroline. I think one thing that characterizes what we do is we're very passionate about building businesses. It is very key to everything we do. And especially important when we engage with different entrepreneurs because you have family member, at times a husband-wife team who through sweat, tears, and blood have built a business to a certain point in time and now want to take it to a different level. And there's a lot of passion wrapped around that business. And as we engage with those entrepreneurs, we need to know how do we actually work with those entrepreneurs, build relationships to actually help scale the business. Now, in terms of how we're structured, we actually were birthed from a public-private sector type partnership. Dr. Adesina, when he was Minister of Agriculture in Nigeria, wanted to bring a new type of capital to the agriculture sector and made a case to the Nigerian government and the German government to anchor a private equity fund. So a big chunk of our capital when we first set up came from the Nigerian government, which is quite unusual because it's not, you don't see quite frequently a sovereign investing directly into a private equity fund, directly not through a sovereign wealth fund. So we got that anchor capital in 2014 from the German government and Nigerian government, combined $28 million, and then went out into the market with those anchors and raised additional capital from 5 other international development finance agencies, CDC, ADB, and a few others. And in terms of how we approach investments, so we typically look at companies $1 million in size revenue to $50 million revenue size. We invest $500,000 to $6.5 million. We are right now focused in Nigeria, and we invest across the value chain. So we look at logistics companies, we look at storage-related companies, processors, livestock, a good mix of entities. And we also have a technical assistance facility as well. So Pat mentioned earlier the different spectrum. So in addition to being on A, we actually have a small pot of grant money, C category, that we can use for certain capacity building, certification, different things that are long-term important, but hard to justify with short-term commercial money that we can wrap around with what we do. Now, I think it's also important to give a couple snapshots of the types of companies we engage in and the issues they face. Because many complex issues, lots of people issues, and so there are many different moving parts that we deal with on an ongoing basis. The first investment we made back in early 2015 was in a dairy company, husband and two wives team, which a dairy company making yogurt. And so even from the early relationship building perspective, you're building a relationship with first the husband, then the first wife, then the second wife, getting everybody comfortable. You have products that's quite good, but there's no cold chain infrastructure in the country. So how do you get your product across Nigeria to all the retail stores? At the same time, they have their cattle herd that they source milk from. They source milk from pastoralists, which have very low, cows with very low milk yields. And they have to blend with some imported powder just because it's so cheap. So you're now a company that we're working with, beyond the people issues, cheap imported powder, boosting milk yields with pastorals that are critical imports, critical raw material inputs, and then you now have to get your product out to all the stores where there's cold chain challenges. So example of some of the issues we deal with. Another company we invested in the Middle Belt in Nigeria, a poultry company. The father passed away. Son was called back to the town to actually run this company and needed some support. So you have family members on the board engaged, one son running this, is now given that responsibility and involved in eggs, in broiler meat, and how do you actually support him to build an environment as well where, and I'm giving different examples because this shows there are many different moving parts. You have raw material inputs that are quite volatile. So if you don't manage some of these issues well, a small player can easily go out of business. And you're in a sector where you have very large players with a couple million birds per company and those that have 5, 10 birds in their backyard. So how do you manage raw material price fluctuations as well as trying to build a business? The last company snapshot is a shea company, a patriarch who is 94, still active, strong, in fact, negotiating term sheets directly with us, and which is quite amazing to see. And thinking about succession. So kids doing quite well in their own careers, not really thinking about coming to run this business, but very conscious about succession. So even the engagement with them is, how do we actually ensure succession, build a team, sourcing shea from primarily women who aggregate the nuts and then make shea butter and export. Now, in all these different issues, they're both the hard agriculture-related science issues, they're the business issues, they're quite a bit of people-related issues. And as we approach the issues, it's the number of different things we ask ourselves because we can't invest in every company, so we're selecting those we can partner with. So the first is, how big is this opportunity? And this really goes to the commercial side. Is this really a big opportunity that if we engage, we can have something that's very exciting? Then the next question for us is, if we then allocate dollars to this opportunity, how should we direct those dollars to then get that growth? Where should these dollars go? Equipment, people, how do we allocate these dollars? And then after that, what are the critical 2, 3 issues that we need to focus on very heavily and that will then create that value? And then we now pull these different things together. Some things we can control, other things we can't. And in the people issues as well, there are many soft issues we're engaging with because you have passionate entrepreneur. We're now trying to see how do we aggregate talent around these companies to then create value for our investors. But at the same time, as we're creating value for our investors, those families, those entrepreneurs we engage in should also hopefully have value created for themselves and have a business that is long-term sustainable.
Thank you, Mazuo. I'm going to change our program. We're going to go around and I've asked each one a question. But I just want to throw the questions out to the audience, and then when there's time left over, we'll go around for one round of tweet. So let's open up for questions because there's a lot of information here. I just also want to remind everyone, 1 minute question, please. All right, we have a microphone is coming. Let's try again. Hello? Oh.
We could repeat the question too.
Okay, let's just try to hear it. There's something coming to you also.
Okay, I'll just ask it.
We'll repeat the question for you.
I've been doing research on the scaling strategies of PPPs for quite a while now, public-private partnerships, but also other organizations in general. In terms of scaling, what we often see is that many initiatives fail from moving, like the slide from Patricia, from the right side to the left side. So actually moving from grant funding, public funding, and making that switch towards more commercial investments. We see this in like maybe 80% of scaling initiatives failing to make that switch. How do you deal with that as different types of financial institutions? Do you deliberately help your the organizations that you fund maybe in guiding them towards next stages, so maybe linking them to next type of investors, or maybe you manage different windows, or do you deliberately deal with that in some way?
So the question relates to the fact that a lot of these small enterprises may start up at the C category, which are kind of grant funding, or from sources which don't have high expectations for returns. But eventually you have to move into more and more commercial sources, but sometimes they cannot make the transition. And what are the suggestions for how to help them make that transition?
And I'll be happy to give you an example. Under the tremendous leadership of Carolyn Wu at CRS, I'm on the board, and we have a dual strategy at CRS. So taking programs, and you called them projects this morning, that are recipients of grants or loans, how you scale those up into the B category or maybe even the A category. And we worked with 2 groups within the organization. Those investors and a lot of professionals that we have on the board that volunteered their time and looked at examples where perhaps there was an alignment with our geographies and our sectors. And one of our first investments with Ascension Healthcare, Tim Runnels, and another one with trade finance, and we're trying to finalize one now in agriculture in Africa. So learn from them and get some of those people to come alongside the people in the field. We got 7,000 people in the field at CRS, and work with those people. Secondly, working with our program people in the field to try to identify, using certain characteristics and criteria and bringing in mentors, those programs that are potentially social enterprises that could be scaled up. And again, using outside expertise and using the internal expertise. Because one of the things that institutional investors love is if you can bring to them a proposition of a pioneering business model that will scale up with local support, with people who know what they're doing. And I think that that dual strategy is one that works. And finally, a resource for everybody in the room, there's a group called Convergence Finance, which gives grants. If you have an innovative idea about scaling up from a grant program, a project to a social enterprise, and I'm on the funding committee, it's Convergence Finance, and we give grants for those people who want to try to do exactly that.
Could I answer as well?
Sure.
Or do you want to go first?
Yeah, I'll just real quick. I think from a donor perspective, I think you also have to be careful you don't inadvertently crowd out private capital, because grants can be like a drug to a company. You know, you get low-cost money, free money, and you then adjust your business model to meet the needs of that donor. And if you then say there's a need probably at the smaller company level, you have to be careful that you don't go up market where private capital will be interested in. And if you're offering subsidized capital, you crowd out our money. And the way we think about it, if the business opportunity is really interesting, we'll find that company. So you don't need to go look for us, we would find that company, that business. But if we're now faced with a situation where we want to provide commercial money, which is expensive, but the company is used to and comfortable to getting subsidized money and decision from them as well. Do I take your equity and give up 30% of my company, or do I take this grant funding and I don't? And it becomes tough and easier, well, depending on your perspective, they would go to that cheaper capital. So it's just being careful as a donor, you don't inadvertently crowd out private capital money.
I think the last thing to add is that people have a misnomer that grant money is easy money. And if you're trying to get it in size, you know, we're trying to raise $65, $70 million, you're talking to some of the biggest donors in the world, and they're the smartest people in the room. They see everything, and they know how to structure something to protect themselves, to make sure you achieve your mission, make sure you achieve your impact. And so as you go down the scale with them, and you say, okay, I need to move towards more commercial financing, they're going to work with you to a degree. And they're going to work with you to the point where, you know, if you want to pay interest out at a commercial rate, they'll say, yes, you can certainly do that. But I think the thing to always keep in mind there is that any money you pay on interest or return to an investor is money you're not necessarily spending to improve the lives of the farmers that you're working with or the people you're working with on the impact side. So you have to kind of balance that as you move down the scale and move up towards sustainability.
There's a hand here, I think.
Thanks. Along similar lines, I guess, Paul Winters from EFED. Do you factor in the investments that are going on by the public sector in the decisions that you're making, or by donors like the African Development Bank or EFED? And the reason I ask is part of what we see is, you know, we have the public sector spending money in agriculture and doing all sorts of things, rural roads, ag extension, whatever they're doing. And then we see these impact investors also doing things in agriculture. And it seems like a horribly missed opportunity to get some synergies between the two. If you're putting in rural roads, you'd think that there'd be some opportunities for private sector investment. And so you would take advantage of that opportunity. So I'm wondering whether you think in those terms at all.
I'm looking at Mezu because in his fund, he's got a number of the public donors alongside private. And we're already working together. And a lot of the funds that I invested in when I was running the private equity business are already public sector. And they can bring certain attributes besides capital. And one of my goals when I was an investor, I want to be the most value-added investor in this fund. I don't want to just bring capital. And you're absolutely right. There's certain things that the public sector can bring, and we really need to work together on that. But, as Mezu said, you don't want to crowd out the private sector. The public sector can be a great catalyst. And in that blended finance structuring, they can guarantee first loss, and they can help bring in the private sector, but then get out of the way and get that huge pool of private capital, because there's not enough government money to go around to solve all the problems.
Julie Howard, CSIS. I'm wondering, the reason that traditional banks don't lend to agriculture is because it's so risky, blah, 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 returns are higher in other sectors. How, in each of your models, do you deal with catastrophic failure among your lendees? Catastrophic wipeout failure, death of chickens, or total crop failure. How does it differ across your models?
So, great question. And you know, one of the things that we always say to ourselves is we want to live another day to provide, you know, the business that we're doing for the farmers. And so we're the largest, maybe not the largest, but we're one of the top 1 or 2 or 3 largest buyers of crop insurance in Africa. And what that does is it protects the farmer, first of all, because if they have a weather event or they have a yield event that prohibits them from being able to repay the loan to us, then we can you know, make the human decision of not crushing a family's life by demanding payment. And then equally important, it helps us protect ourselves because then we get the payout from the insurance company in that regards. And it's very expensive. And what we've had to do is develop incredible monitoring and evaluation systems that are really down, they're not quite down to the site level, which is, you know, 200 farmers, but they're down to a district level of maybe a few thousand farmers. And we're taking yield observations on those places and comparing them to historical yield patterns to make sure that the farmer's crop is growing. And we do that in 6 of the 7 countries right now where we operate. So, and it's done with commercially viable, or not commercially viable, but commercial grade insurance companies that we all would recognize the names for. On top of that, we actually have a full credit default insurance program that protects us even more because some of the things that we sell aren't agriculture related, and so they wouldn't fall under that crop insurance type protection. And so that protects us as a second layer, as an excess loss.
Very real, pertinent question. We have a rice investment in southeastern Nigeria, 2,500 hectares of land. We've cultivated 1,005. We're putting in place a 40,000 ton a year mill. We're also partnering with small farmers. And there was a massive flood last week. Heavy rains, northern Nigeria, flowed down the rivers, wiped out many different farms, commercial, small, including ours. Quite painful to see, just as we started harvesting. So harvested maybe 350 ton equivalent of rice paddy, but everything else gone. We're expecting 15 times that. Now, answering your question a couple different ways. So insurance is very key, not only for your commercial farm, but for the small farmers you engage with. But the reality, at least in Nigeria, is that insurance doesn't cover full value. It covers cost of inputs. So there isn't appropriate insurance products today to deal with some of that huge loss, but you have to have insurance products in place. And we actively engage with different stakeholders to increase the variety and the depth and type of insurance that's available. Now for us, we're also long-term investors. So we're doing equity products, equity investment, not debt. There's no debt repayment due next month or in 6 months. But for us, it's a long-term investment, seeing how to actually build a core sustainable commercial farm, so everything from dikes and water drainages. So we had at dikes at the 25-meter level. We now know that we need to increase it another 3 meters and do that over the course of the next few years. But then how do we also work to protect the farmers as well? Now, separate from that, most people are not doing dry season farming. It's rainy, wet season farming. So we've put irrigation in our current farm. And for this, there's a pool of small farmers we're working with on 1,500 hectares of land. Irrigation was put in place by the government 25 years ago, hasn't worked in years, so they only do one cycle. So part of our engagement is fixing that irrigation pump so that they can actually do dry season farming. So in a worst case scenario, at least the floods in dry season, unlikely. But real issue, we take the long view and we then put in place different things to mitigate. And there are other ecosystem initiatives like building the insurance product that we need to be engaged in just to ensure that we minimize some of that risk over the long term.
And from our perspective, market offtake is one of the key risks. If you put finance into the field and you don't know where the crop is going, then you're heavily exposed. So we work very closely with buyers to understand their commitment and to use their purchase orders as a way to mitigate risk. We have in-country loan monitoring as well, identifying what's happening. When we put out cash, that cash needs to become inventory and be converted back to cash to repay us. So we want to know exactly what's happening on a month-to-month basis with that business. And then the financial management training is key as well, because we're working at the enterprise level. And so making sure that they have proper accounting systems to track their needs. But just to pick up on the last question, we have a borrower in West Africa and in Benin, and it's one of the largest employers in the country. They're located a couple kilometers from the main road, and they don't have access to power because the government hasn't provided it. And so that business has to do their own rigging to get electricity, and the reliability of that electricity is crucial for our finance. And so really, especially when you're making smaller investments, a few $100,000, $1 million, you're not going to get the government's attention. You're not going to get the attention of multilaterals, and you're just understanding all of these risks, deciding how significant they are and whether you're willing to take them. And that comes back to my point earlier about why a lot of these loans are unprofitable, even if the underlying business is viable. It's because there are systemic risks that the public sector has not mitigated through investments in electricity and roads and other infrastructure.
Hello? Can I go?
Okay.
I'm Joe DeVries from Agra, and the question is for Brian Heath. So you described your main business as being selling seed and fertilizer to farmers, and yet that's a lot of, there's a lot of agricultural business people in Africa who are either doing that or would like to get into that same business. Don't you worry that you would be displacing their opportunity? Because obviously they're not eligible for donor funding.
Great question, Joe. Great question. And I think that's one of the things that we definitely struggle with and give a lot of thought to. We try to charge market prices for the things that are available in the country. So if you can get seed locally, when we include that in our bundle, we'll charge the market price for that so that we don't really crowd out the local sellers of that, because we want the market to survive on its own. The same with fertilizer. In the countries where it's available, where good, high-quality fertilizer is available in the country, we do our best to charge the market price. I think the part where the subsidy comes in, and the donor subsidy comes in especially, is on the parts that maybe you can't get locally, such as the training that we provide, and we have a 12-stage training process that we work with farmers on that covers everything from agronomy to financial management practices, and those are the types of things that I think the donor subsidy helps to support. A second thing the donor subsidy tends to support in the model is, as Brian was saying, it's just very expensive to service the farmers and collect the money that we're giving people on credit. The goods we're selling on credit, we have to collect that money back. And so, that's another thing that the donor subsidy tends to support as well, because, we have 7,000 field agents across the countries where we work, and they're the ones who are out, training the farmers and collecting the money. And that's difficult to get done at market prices right there, because it's very expensive to pay people and to have have it done profitably or financially sustainable. Does that answer your question? It's a great question, because I think one that cuts. We definitely think about. Does it encompass the answer that you were looking for? Okay, cool.
Well, Brian, I want to ask. In some ways, you cover working capital, I presume.
Yeah.
And do you cover that working capital at a rate which is, how does it compare with the market?
Well, our borrowing cost rate is weighted average about 4% in US dollars. that might seem to you to be very low for investing in agriculture in Africa. But the debt that we raise is very short. I mean, it's about a growing season long on average, so it's about a 1 year. And you can borrow risk-free in the U.S. markets at about 2.5%. So we're paying about a 1.5 above that. And the way we like to think about it is that the lender is very well protected from the covenants that we provide, as well as the financial management that we have, as well as the insurance that we provide. So we're really trying to de-risk the model as best we can. I mean, it's not perfect, but having spent my life in the lending world, it's not as bad as people's first impression of investing in agriculture in Africa can be. And so I think that can bring the cost down.
So we're
And
coming
you're
almost.
very good. Just Brian's Root Capital is also very good at low-cost capital as well.
Yeah, I think, Carolyn, were you asking about the capital coming in to 1 acre or the interest rates that they charge farmers?
The interest rate that they charge.
Yeah.
Oh, okay. So that's obviously a little bit higher. I mean, it comes out, but it compares favorably to the microfinance model that you'll see of like 17 to 18%, depending on how long it is outstanding, though.
So we're coming to an end. I don't have time to ask you a question, but for each of you to reflect on either the risk or the opportunity you see in deploying capital in Africa. Okay, so a tweet level response. You can think about your pain points or your most exciting opportunities. What do you want to leave this group with?
I've got okay, reverse innovation. Think about the old days when the innovations came from the developed world and trickled down to the emerging markets. Your big opportunity is reverse innovation. Find those brilliant business opportunities and let them rise up and defy the laws of gravity and attract capital.
Thank you.
We serve 700,000 farmers, and we have about 1% of the market, we think. So there's a huge runway for everyone to play in this market to help improve farmers' lives in Africa.
Economics 101, there's a massive demand of capital. There's a lot of potential supply, but the risk and return don't line up. And that's where I think the blended finance and the smart policy incentives, public subsidy is needed to bring those together.
And I think as SMEs and small companies scale, I think it's important to realize it's about the people, not only the families that are building the businesses, but also the talent and people you need to wrap around those companies to actually allow them to scale and build.
Well, thank you very much. Let's give the panelists a big hand. Thank you. So now I'd like to bring up the colleagues who will be presenting after dinner to give a quick sort of preview.
Yeah, it's not going to be a presentation tonight. It's going to be a discussion. And it's focusing on seed markets and seed systems, but with 3 special lenses. How do we get scaling and delivery really at the last mile? Places like Kasai, Kivu, northern Mali, southern Malawi. Second lens, how do we move climate stress technology or seed? I mean, it's great to have the WIMAs, it's great to have the drought-tolerant maises. How do we move them and sell them in really high-stress, let's say, drought areas? And then the third lens is going to be on nutrition and the malnourished. Seed systems, seed technologies, to help those who need boosting. We have these biofortified varieties. How do we sell them and move them to a very specific client group? Now, why this looks like seed, anyone's welcome, and we need you, who's interested in last mile, climate stress, malnourished. And just a final thing, this has been fantastically exciting, this first day and a half, but I'm wondering if we're really scaling toward the very, very poor. What kind of farmer have we been addressing?
Thank you. Paul?
Paul Winters from IFAD. So when IFAD hired me, I was a professor of economics at American University, and they hired me because I taught courses in how to measure, right? Project evaluation and measuring in M&E. When I got to IFAD, I heard about this scaling up agenda, and I thought, well, you know, you scale up results. You just measure the results, and then you figure out how to scale up. I think it's a little more complicated than that, and that's what we want to discuss. And so there'll be a session on M&E and scaling up and the types of things that you need to think about in terms of data collection, information that you need to scale up. So that's what the session will be about.
Thank you. Johannes?
So I'm Johannes Lin from Brookings. I will be talking to you about a topic that maybe could be misunderstood. The topic is institutionalizing scaling. I just want to clarify, we're not proposing to lock anybody up. Instead, what I think a better title might be mainstreaming the scaling agenda into organizations, and that's what we'll be talking about. I've been working for the last 15 years after about 30 years at the World Bank. I've been working for 15 years with about 20 organizations in the development business, trying to help them deal with the scaling up agenda and mainstream it into their institutional DNA, if you wish. And so I would like to discuss with you the experience and the lessons that I've learned from this and get your input and what you've learned in your efforts to try and get this idea of scaling up into your organization and so that your organization effectively supports scaling up. Just the last comment this morning, the second panel that I think Paul chaired, three of the panelists, including Paul, sort of ended the conversation by saying the biggest challenge we face is actually mainstreaming the agenda into our organization. So we're sort of picking up from that particular point and to discuss the challenge of how to mainstream, institutionalize the scaling agenda. Thank you.
Thank you. Sia?
Hello, my name is Sierbert Bolders. I'm from Wageningen University and Research in the Netherlands. And I also represent Tricia Wind and Rob McLean from IDRC Canada. And coming from different research directions, we found a common interest in what makes for responsible scaling of innovations and why taking such perspective seriously is critical. As mentioned many times by earlier speakers, scaling innovations has had positive effects for large parts of society and still has such potential, and we acknowledge that. At the same time, as earlier speakers mentioned, getting scaling processes right involves considering quite a number of issues, not just in terms of getting things to go to scale, but also in terms of seeing this contribute to really positive impact for all. So benefits from scaling particular innovations may have both positive and negative effects. Positive for some groups, not for others, or positive in one sphere of life, maybe the economic, and not so positive in other spheres of life, maybe the social or environmental. Also, the cumulative and interacting effects of scaled innovations of many scaling initiatives may lead to undesirable compound effects at scale. So this points to the need for developing a practice of responsible scaling of innovations, which pays due attention to long-term implications, developing a holistic perspective on who and what affects and is affected by scaling innovations, considering optimal scale, moral justification, dynamic evaluation. So we'll present a few bits from our research and findings and look forward to having meaningful interactions with you along these lines by connecting to your experiences and perspectives on the topic. And we'll be in room 218 to 18.
Thank you, Sia. Sean, last but not least.
Hi, everybody. Sean Ferris, CRS, room 202. We're going to be talking about ICT for D and particularly focusing on the areas of agriculture. I think as we've seen over the last day or so, the whole discussion about these major drivers and trends, the two key things that I think you really see happening in Africa that are really dramatic are the changes in population and the mobile revolution. And I think that we also hear a lot of the other sides of the challenges that we see in Africa, which are based around climate change, poor infrastructure, slow technology change, and also the ideas of very atomized farmers. But I think ICT does provide a solution that can actually take the very best aspects of the African agricultural system and use that to leapfrog some of the other problems. So I think we've heard from several speakers over the last day about what some of those sort of things are. So things like extension. How can we use ICT to improve extension? How can we use ICT to improve data management from different systems so that we can see where new investments may be possible? How can we use mobile money to make investments? And there's been dramatic changes in that area. How can we start to bundle these different types of single point applications into more value chain support approaches? And how can you then start to get into what I think is more the second generation of ICT, which is looking at artificial intelligence, machine learning, all of those sorts of things which can really enhance what we know about the agricultural system and how we can use that information, again, to really enable people to see technology, see where it can work best, and then to find ways that we can finance. Now, I am an expert in none of those areas, okay? So this is definitely going to be something which is a facilitated conversation. I would really like to invite people to come along that know a lot about this so that they can help us discuss it, and people that are just interested to learn more about the session. So if you're interested in how ICT is changing the world of agriculture, I think particularly in Africa, room 202. Thanks very much.
Thank you very much. So I just want to say for dinner, I don't know if my microphone. For dinner, we go back to where we were for this afternoon. It would be a quick dinner, 5:30, and go back before 6:30. All the sessions will be again on the second floor of this building where dessert will be. We're not serving dessert with dinner, but serving dessert with the speakers. Again, there will be 2 sessions. You could choose 2 topics, and they are listed in your program. So thank you very much. Let's give everybody a big hand. Thank you.